If you're a DIY investor and are currently struggling to make money in the stock market, well, you're definitely not alone, because new research actually shows that over 70% of investors actually lose money when investing into the stock market.
Lost everything.
So how do you put yourself in that top 30% of investors? After all, the sole purpose of investing your hard-earned money is in order to grow your wealth over time. And it's certainly not to finish off the year posting losses on Reddit from a £72,000 options trade that went badly. So how have the most successful individuals made their millions from investing? Well, for the most part, it's actually quite simple. And the truth is, most DIY investors actually overcomplicate things when they really don't need to. Let me explain. When investing, it's super important to remember you're actually buying shares within a company. Sounds obvious to say, but most DIY investors actually spend more time looking at the fluctuations of a stock price rather than understanding the fundamentals of the business they're investing into. This is a big mistake that so many investors make. Warren Buffett once said, never invest into a business that you don't understand. So that should be your first and foremost number one priority. And of course, that business should be one that can actually provide you with a return on investment over time. Let's just think about this logically, and let's say that you had two friends with two businesses that you could invest in. You've got profitable Polly, who makes £100,000 per year and turns a profit of £40,000. And then you've got Spendy Scott, who makes £150,000 per year, but he makes a net loss of £20,000. If you had £10,000 to invest in either one of these businesses, where would you put your money for the highest probability of a return on that investment? You can certainly let me know down in the comments what you would do, but for me, if these were my friends, I'd be giving all of my money to Polly. Why? Well, profits are A, what gives a business value, and B, are what can be distributed back to you as a shareholder via a dividend. But here's what I find quite baffling. Investors, by and large, very much have an appetite to invest in unprofitable businesses. And look, I'm certainly guilty. I've done it myself in the past, and well, full transparency, the results kind of speak for themselves.
It's just a terrible investment.
And you can't exactly be blamed for doing so. And let me show you the reasons why. To research stocks, I use something called a stock screener over on a website called finviz.com. And on that website, there's a database of 8,633 stocks that captures publicly traded companies from all across the globe. But what I'm about to show you guys will probably blow your mind. When I filter my search into companies that have a positive net profit margin, the company's remaining drops to 2,555. This means we're actually looking at a total of about 70% of publicly traded companies that are actually unprofitable, and therefore less likely to be able to provide you with a stable, consistent, long-term return on investment. And actually, for the most part, all of the other unprofitable companies, you'd largely be speculating on them being able to generate a profit at some point in the future, which is certainly a high-risk way to go about investing. And that's where keeping things simple becomes so important, and actually just looking at the profitable companies that are available to us is probably a good place to start. Because in actual fact, the top 10 companies within the S&P 500 actually delivered 90% of the returns during Q1 of this year. And as you'd probably expect, all of those companies are profitable ones. So as the data suggests, certainly aim to invest into profitable businesses rather than speculative loss-making ones, because it will certainly pay you dividends over time. But what won't pay you dividends is your investing mentality, especially if it's tuned in the wrong way. My fiance would say that I'm stubborn as hell, especially after an argument. But when it comes to investing, that stubbornness can certainly work favorably, especially when market conditions are unfavorable. Here's why. Investing psychology has a huge part to play when it comes to your overall success as an investor. And unfortunately, we're largely influenced by YouTubers and the media, which certainly present a doomsday scenario every other week. And because of that, it certainly pushes a narrative of selling all of your equities and dashing for cash instead. But actually, throwing in the towel can be absolutely catastrophic to your long-term investment performance. And here's why. In every single market crash where the market fell over 25% or more, data shows that if you just stayed invested in the market and did absolutely nothing, the time it took to recuperate your losses would be massively shorter. Here's the data. If we ignore the 1929 crash as a bit of an anomaly, in the other 10 market crashes, if you actually stayed invested, the time that it took to recuperate your losses on average would be 2.28 years. Whereas for the investors that bottled it after the crash, it would take them over 9.6 years on average to recuperate their losses. With the 2001 and 2008 market crash, actually those investors would still be underwater right now. Now get this, for another crazy piece of analysis, there is something called the VIX index, which essentially assesses the overall volatility of the market. In actual fact, it's a little bit of a fear and uncertainty index, which very much can highlight the overall sentiment about the market at any given point in time. Now, Schroders analysed the returns of investors who moved to cash when the VIX was greater than 30, which, as you can see on the chart, is typically when there's been more fear and uncertainty in the stock market in the past. And they compared that data to investors who just stayed fully invested regardless. They found that between 1990 and 2021, the fully invested investor outperformed by 2.9% on average per year, which certainly doesn't seem like a lot, but compounded over 31 years would have left you with a portfolio value worth 59% less. That's the difference between being able to retire versus not. So don't dash for cash because it could cost you big time. This right here is Warren Buffett. If you're a stock market investor, you've probably heard of him before. He's got a net worth of $118.3 billion, which actually makes him the 5th richest bloke on the planet. He only invests in what he believes are good quality stocks trading at good value. And for the most part, he holds onto those positions for many decades, and he rarely sells out of the equities that he's purchased. He's held stock in Coca-Cola since 1988, which is currently worth $24.1 billion. He's held stock in American Express since 1991, which is currently worth $26.4 billion. And he's held stock in Bank of America since 2007, which is currently worth $29.6 billion.
Wow, that's a lot of money.
Now, of course, we'd all like just a tiny little slither of Warren Buffett's net worth. But Warren Buffett's secret sauce isn't so much about the stocks that he's picked. It's more about how long he's been invested in those stocks for. He's been quoted saying in the past, if you aren't willing to hold a stock for 10 years, don't even think about owning it for 10 minutes. And that is where so many investors run into their own downfall, because they want their investment returns almost instantaneously, which leads to decision making that leads to poor results. Because let's be honest, getting a 10% return on a £1,000 investment portfolio isn't exactly going to change your life. And because of that, investors typically lean towards over-leveraging, taking on too much risk, and just blindly speculating.
And now the market... Oh! It went to zero!
But the truth is, nobody needs to do that in order to make a substantial amount of money from investing. And this is the single reason why. Warren Buffett actually generated over 99% of his net worth after the age of 50. The power of compounding did all of the work for him, which allowed him to grow his wealth by billions and billions of dollars per year. And he did that by consistently investing into the stock market over many, many decades. So remember, time is your friend and impulse is your enemy. Take advantage of compound interest and don't be captivated by the siren song of the market. But look, in order to become a great investor, first you need to put yourself in a financial position to become an investor. So if you want to know how to do this and actually how a normal person can actually become rich, then be sure to check out this video next. And with that said, see you over in the next one.